process of diversification is necessary, but you need exposure to these magnificent seven.
We want to be a little bit more defensive. It doesn't mean equities can't do well. It's the larger cap. It's the higher quality. It's because growth's slowing.
In the small business sector in particular, the squeeze is quite intense.
In pockets of small caps, there's still a lot of opportunity.
Inflation's moderating, so it's an ideal scenario for the stock market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Wednesday with equity markets pulling back across the board on the S&P, on the Nasdaq, on the Russell. Check out the Nasdaq 100. Underperformance this morning off the back of disappointing earnings. We're down by more than 1 full percentage point. Switch up the board and get to Tesla. Missing expectations for a fourth consecutive quarter. Bramo, that stock is down by almost 8%.
And this is partly because the hope for robo-taxis is being pushed back again and again. It's partly because they miss yet again the expectations in the market. And it's partly because for the first time, it doesn't seem like there's a lot of enthusiasm behind some new product or new idea that's going to be put forward. The political angle of Tesla also becoming increasingly interesting.
Let's get into the political angle. Mexico, Elon Musk, quote, Trump has said he'll have to put heavy tariffs on vehicles produced in Mexico, so it doesn't make sense to invest a lot in Mexico. If that is going to be the case, there is an auto manufacturer making capex investment decisions based on the outcome of November.
You could see the political uncertainty is starting to affect business decision, Tesla being one of them. And this was a direct link. Really, for the first time, we saw Elon Musk. They've been slow walking this plant in Mexico. Now he's linking it directly to November 5th. So TBD, basically, whether or not there's going to be more money investment that plant opens, depending on who wins the presidential election.
Well, to me, I'm just looking at this. And first of all, you also saw margins compress pretty considerably because of some of the tariffs already in place as a result of some of the increasing trade war, number one. Number two, there is a real question about Elon Musk himself, who has supported Donald Trump for president, who has put a considerable amount of money, although a bit less than he originally pledged, to that campaign. Coming out, it raises the question, if the person he's seeking to elect has policies that might be negative for his business, is he being pro him in order to curry favor, or is he being pro Donald Trump in order for social reasons or something else beyond the economy that he views?
He was also asked about the subsidies for the Inflation Reduction Act. And this is what he said. It would be devastating for our competitors, and it would hurt Tesla slightly. He said the value of Tesla overwhelmingly, though, is autonomy. So basically what he's saying is in the short term, losing some of that IRA juice might hurt. But long term, it might help us because it's going to hurt our competitors even more.
A difficult morning on the stock front for the likes of Tesla stateside. Over in Europe, LVMH taking a bit of a beating as well. Numbers yesterday afternoon, not fantastic. That stock is down by more than 4%. I'll go through things for you line by line. Fashion and leather goods revenue, just plus 1%. Compare that to a year earlier. We were talking about double-digit revenue growth of 21%. Sales in the region, including China, down double digits. Do you want an extra political angle to all of this? Goldman Sachs on China. This is what they've got to say. The reason why they've been cautious on doing a lot of fiscal stimulus or demand-side stimulus is just that there is the risk of Trump. I think some of the logic is just let's save the ammunition in case we need to do a lot more in 2025. So if you're a luxury goods maker selling into China, hoping things pick up anytime soon, there is a nod from Goldman there suggesting that Chinese authorities are waiting also for the outcome of the U.S. election.
Well, and you just basically heard that. There wasn't any incentive in the recent get-together in China to really put forward or juice consumer spending. There also was a foreign exchange angle of this, which I absolutely loved.
Japan.
The fact that Chinese consumers were going to Japan to get their goods because it was a lower price because of the currency differential, and that was shrinking margins. It's just brilliant, frankly, of the shoppers from China, and I kind of envy it them.
Massive. Lift sales by 57% in Japan. Maybe your son was one of them. Also, thinking of the political uncertainty when it comes to the election, Bernard Arnault also came out in his statement, talked about the climate that's happening, the geopolitics. All of this remains uncertain. And Citi had this to say, no miracle with the luxury bellwether. The sector is likely to remain out of favor near term. So it feels like at this moment, it feels like this week was a complete election reset. We're going to hear from the president tonight. But also, companies are really starting to take into account that they need to wait potentially for some of these decisions or how their business might pick up till after November 5th.
The beatdown of European luxury has been quite notable over the last few weeks. Burberry, got absolutely battered. Saw a similar story in Hugo Boss, if you still call that luxury, but that's a conversation for another day. Equity futures on the S&P 500 look like this on the S&P. Equity futures down by 0.7%. That was brutal, wasn't it?
That was.
Yields are lower by about a basis point on a 10-year. I used to wear Hugo Boss.
I was going to say,
changed.
don't you wear Hugo Boss?
Used to.
I still do.
We've been
Used
to Hugo
to.
Boss together.
Used to. Long time ago.
Oh, it's not cool.
Things have changed.
What do you wear now?
We can talk about the quality. I'm not giving anyone an endorsement this morning. 424.27 on a US 10-year. In foreign exchange, the euro is slightly weaker by 1/10%. 108.42, but I'm available for endorsements if you pay enough money. All right? I'm not. I can't accept anything. This is going too far. Coming up this hour, Greg Boutle of BNP Paribas with big tech dragging stocks lower. Bloomberg's Jordan Fabian ahead of President Biden's address tonight, and Ben Kallo of Baird as Tesla reports another quarter of disappointing profit. We begin with our top story, big tech driving stocks lower as earnings season kicks into gear. Greg Boutle of BNP Paribas writing this. There has been some notable softness in some bellwether cyclicals. This is at odds with the macro narrative for Fed rate cuts driving a re-acceleration. Be careful what you wish for with softer data. It can become too soft. Greg, good morning to you. It's good to see you.
Thank you.
Let's start with this line. Bill Dudley, former New York Fed president. I've changed my mind. The Fed needs to cut rates right now. He's looking at the labour market. He says it's time to go. That's a big change for him. What do you think?
Yeah, I mean, the thing about Fed cutting cycles and what they mean for equities, they're difficult to navigate because they mean one of two things. Either the Fed's cutting because it can, because inflation's benign, that's generally good for stocks, or it's cutting because it has to, because the data's slowing down a little bit too much, and that tends to be more negative for stocks. So that's the question we have to answer.
Can you answer it?
Well, I think earnings season is what we're going to use to answer it, and we're going to see how that progresses. Now, we're still early in the earnings season, but so far it hasn't been great. So I think there is some evidence that some of that slowing in the macro data is starting to feed through to corporate earnings, and that creates a less constructive backdrop for stocks.
Part of this is by design. We were talking about this yesterday, that essentially it is the Fed. John Stoltzfus was saying you can't really look at this and be surprised because the whole point was to slow down the economy in order to get weaker inflation. What's your argument that says it's a pernicious enough weakening to cause the sell-off in equity markets that you're expecting to get down to 5150?
Yeah, I mean, honestly, it may not. So we have to wait and see how the earnings unfold. The year-end target we have of 5150, we set back in February when it was above the current spot market. So what we've seen is the market overshoot, and we've seen an extension of PE multiples, high teens rally from equities, and essentially what we think we need to see is a bit of a re-acceleration in earnings to take the market higher from here. Based on the evidence we've seen so far from earnings season, that doesn't seem likely.
There is this political angle to it. We were just talking about how this earnings season has actually shown companies are truly postponing decisions in order to wait for the political tides to come into clearer focus. How much does that also diminish the possibility of a reacceleration of earnings just simply because there can't be that many big moves made if there are these sort of potential tariffs or potential restrictions or potential regulatory pressure that could come to the fore?
Yeah, I'm not sure how much market participants are wary of the election. You can look at what's priced in by the volatility market specifically for the election, and that's at the lowest levels that we've seen during this election cycle. So if anything, some of that election fear has been dissipating as the polls have been shifting. And I think if anything, it's been driving some of the pro-cyclical rotation, the outperformance of the Russell that we've seen over the last month.
A lot of people actually are looking through the noise. You think politics is moving the rotation?
I think so, but I think it's one of many things, so it's hard to disaggregate. So what we've seen is positioning reach extreme levels with Russell and the cyclicals being very unloved. And then we had this very soft CPI print, which acted as a catalyst to see those parts of the market that also rallied in November and December rally again as that cutting cycle got more firmly priced, kicking off in September. Now, those are also the trades that people tend to associate with a Trump presidency. So it's quite hard to distill how much of those three drivers is contributing to the move, but all three of them are.
So the three pillars that we keep going back to on this programme, one is politics, the other is rates. We've got to talk about the economic data and the earnings. You're reading into the economy based on the earnings. I think that's interesting because I find it really difficult to read into the economy based on the earnings at the moment.
Yep.
We had the conversation at the start of earnings season that Dow was pretty good, or rather pretty bad. Pepsi was pretty bad. And then yesterday, GM was pretty good. Coca-Cola was pretty decent. Which one gives you a better read of things right now? What do you look to?
I guess the price action from GM wasn't that great, even if the numbers were. So I think that There has been a little bit of something under the surface in earnings season. There's a little bit of a market cap bias. Some of the bigger stocks have done better than the smaller stocks, which is the opposite of the price action we've had coming in. I think there's a little bit of softness in the more cyclical stocks. So if you look at the consumer, many of those names you mentioned earlier, you look at UPS, there's a bit more softness, I think, in some of the cyclicals. So I think we'd be careful looking broadly at the earnings season, large cap tech and the defensives to get a read on the economy. It's the cyclicals that you probably want to focus on to get more of a macro read.
Going back to how we started this conversation, do you think we do run the risk of being in the wrong side of this rate story? That they're cutting rates because the economy is already decelerating and that re-acceleration that people are positioning for in small caps ain't going to happen?
It's definitely a risk. So I think one of the things that we've been saying is that we're at a point now where obviously we've had massive outperformance from the large caps, the AI bellwethers. We've now had this squeeze higher in things like the banks and the small and mid caps. So what we're at risk of, if the data does slow more than most expect through Q3, Q4, is that you get a more correlated sell-off. More correlated sell-off is ultimately what could see volatility spike and the VIX reset higher.
Just going back to your year-end target then, to get there, because you are kind of bearish on the market, and you have been for quite a while, I'm just curious if what we have seen so far, the preliminary look at big tech, is enough to give you a renewed confidence that we're going to get there, that could be what leads us down, even if it's in tandem with growth concerns?
No, I don't think so. I think what we need to see is a more material slowing. So clearly we haven't had much of large cap tech report this season to date. What we have seen is probably a little bit softer at the margin, certainly in terms of the price action. But I think to get down to that kind of year-end target that we have, you need to see a more pronounced slowdown, both in the macro, and you need to see a little bit of a downgrade cycle emerge post-earnings.
Greg, good to catch up with you, sir. Greg Boutle of BNP Paribas with plenty of thoughts on this earnings season and what it might mean for rate cuts later on this year. Bill Dudley, former New York Fed president, making some headlines here at Bloomberg on Bloomberg Opinion, writing, "I've changed my mind. It's time to act right now and reduce interest rates. The facts have changed. I've changed my mind. The Fed should cut, preferably at next week's policymaking meeting, although it might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." I wonder if that gets presented at the FOMC next week and they read out that first couple of lines.
Well, he has a good track record, and maybe if they had read him out a little bit earlier, they would have gotten a 5% Fed funds rate a little bit earlier, because that's basically what he was projecting. What I find interesting is he highlighted that the waning of some of the effect of the Biden stimulus seems to be coming more into fore. In other words, its power is kind of running out more quickly than he had expected, and not necessarily offsetting the restraint that you're seeing from the monetary policy. So that aspect, I think, is what's really kind of getting him a little more worried.
I'm picking up on that as well, because he's talking about these vast investments the Biden administration made, whether it's the Chip and Science Act, Inflation Reduction Act, the Hard Infrastructure Act. And if that's what you think, and potentially that demand has started to wane, then the Fed would be cutting sooner. And you can paint this back to politics two ways. One, there was an issue because of maybe there was too much fiscal stimulus in the market. And then secondly, that means maybe one, if Dudley is correct, or two, cuts before the November election.
We'll get some thoughts on those Dudley comments throughout this morning. Equity futures on the S&P 500 negative here by 0.7%. Let's get you an update on stories elsewhere with your Bloomberg Brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. Deutsche Bank has reported its first quarterly loss in 4 years as trading slowed. The German lender also booked a charge tied to a legacy issue at one of its retail units. CFO James von Moltke told us that the bank is likely scrapping buybacks for this year.
This year, I think prudence would dictate that we step back from seeking a second repurchase authorization. We've already returned, of 1.3 billion to 1.5, billion to investors so far this year, and so we think we're demonstrating an ability to stay on track.
Shares of Deutsche Bank falling by more than 5% in Frankfurt trading. Meanwhile, shares of LVMH are also slumping in the French trade. The company reported a slowdown in sales growth in the last quarter. Shoppers reined in spending on luxury. The big hit, though, came from China, which saw sales in Asia, ex-Japan, fall 14%. Meanwhile, there was larger growth in Japan, which saw an uptick in tourists. LVMH's CFO said that customers were simply saving up, waiting for their next trip to Japan, thanks to the weekend. All eyes will be on President Biden tonight. He's set to address the nation from the Oval Office at 8 p.m. Eastern. This will be the first time he's spoken since he dropped his re-election bid on Sunday. Former President Trump, meanwhile, is demanding equal time. The New York Times reports that he sent a letter to 3 major networks arguing that Biden's speech will be a primetime campaign commercial for Kamala Harris. Trump will hold a rally in Charlotte, North Carolina this evening, 2 hours before the president's address. And that's your brief. John.
Danny, thank you. Did you see him playing golf with Bryson?
I did.
Quite cool, those videos, you know.
Yes, I know. And that will get a certain cohort who likes watching golf on
Yeah,
Sundays.
I mean, like, decent golfer.
Yeah.
Decent golfer. Not a 6 handicap or an 8, you know.
Was he
like,
basically trying
decent.
to get Kamala Harris on the course?
I think he's still trying to get Biden on the course. He can't let it go. Like, you listen to some of the comments, he just can't let it go. Up next on this program, a new election taking shape.
So hear me when I say, I know Donald Trump's type. And in this campaign, I promise you, I will proudly put my record against his any day of the week.
Conversation is coming up next, live from New York City this morning. Good morning. Also, not sure what I think about of LVMH, the CFO, saying that people aren't buying enough stuff because they're saving up to go to Japan again.
Well, what I think is that this is actually brilliant. It's a fantastic FX trade. And frankly, if you can, go for it. Because why not? I mean, you're basically buying it on a discount. And that's the reason why LVMH's profit margins are shrinking.
If you can afford just to go on vacation to buy LVMH, then I'm not sure how long you're saving up to go to Japan again.
Okay, how do you explain Taylor Swift flying to Paris or flying to England in order to see Taylor Swift? It's the same kind of trade.
The tickets are much cheaper.
But it's a very similar analogy.
Yeah, but do you think the Taylor Swift audience is the same as the LVMH buyer?
No, but it's a similar kind of
There's
concept.
got to be someone in the middle in the Venn diagram.
These people are like dropping tens of thousands of dollars on leather goods at any given time. You've seen this in the store. It's amazing.
Well, if that's the case, then what's an extra $1,000 to fly over there?
That's what I'm saying. Do you need that much time to save up? Probably not, right? Anyway, whatever.
Let's move.
Futures. We agreed in the end. You disagreed, and then okay. Futures, negative by 0.7%. Yields unchanged, the 10-year 424.47. Under surveillance this morning, a new election taking shape.
So hear me when I say, I know Donald Trump's type. And in this campaign, I promise you, I will proudly put my record against his any day of the week. I am so very honored, and I pledge to you, I will spend the coming weeks continuing to unite our party so that we are ready to win in November.
It's the latest. Vice President Kamala Harris holding a 2-point advantage over Donald Trump in the latest Reuters poll. That's compared to the 2-point deficit President Biden was facing just last week. Biden addressing the nation at 8 p.m. Eastern Time. It's the first time we'll hear from the president since he dropped his re-election bid. Bloomberg's Jordan Fabian joins us from D.C. for more. Jordan, 8 p.m. Eastern Time, the president addresses the nation. What do you expect to hear?
Well, we'll be looking for his explanation of why he dropped out of the race after, saying only the Lord Almighty can force him to do that. And also, what message is he sending to the nation about Kamala Harris, the person he picked to be his successor? Those are two of the big themes we're going to be looking for in that address.
Jordan, why did it take him so long to appear in front of a camera to the American people?
Well, a big part of the reason, Anne-Marie, was Biden came down with COVID last week. On Thursday, he was in isolation over the weekend when he popped out that statement. But it is odd that, he did not, appear personally to make this huge momentous announcement that really changed the contours of this race. And, there's been a lot of conspiracy theories, too, on the right about Biden's well-being. And so the address is also an opportunity to reassure the public he can serve out his term, in addition to all the other things I listed.
We heard from Tony Fabrizio yesterday, Trump's campaign pollster, and he said the Democrats deposing one nominee for another does not change voters' discontent over the economy, inflation, crime, the open border, housing costs, not to mention concern over 2 foreign wars. He's calling what's happening in the polls right now that John referenced a honeymoon for Kamala Harris. How are you reading this, how Trump's camp is trying to prepare for a brand new campaign?
Well, there's some valid points in that memo, but, it shows to me that they're a bit worried about Kamala Harris. Keep in mind, Anne-Marie, that this is coming off the heels of the Republican National Convention and an assassination attempt on Donald Trump. Those are 2 events in which you'd expect a huge boost in the polls for Trump. Why is he not getting that? I mean, why is that not accounted for in that memo? And also the fact that they prepared their whole campaign to go after Biden and concerns about his age and acuity. This shows that they're kind of throwing spaghetti against the wall when it comes to Kamala Harris. They haven't settled on a message to counter her yet.
And now we have Donald Trump being the oldest candidate ever for president. So the table's being turned on him. There's been a real question around the vice presidential pick and whether that was a mistake for the Trump campaign, whether J.D. Vance is the wrong person to really galvanize a lot of voters. What's the likelihood from the people you speak to that there could be a replacement of J.D. Vance?
Well, I think it's too late to do that for the Republicans. He was nominated officially at that convention just a week or 2 ago. So he's on the ticket. They can't take him off, even if they regret their choice. And then looking ahead to what Kamala Harris has to do, she's maybe not wanting to fall down the pitfalls that Donald Trump had. She wants to perhaps pick someone who complements her style, her strengths with someone else. There's been a lot of speculation about, white male governors. And so that's making up most of the list of who she's looking at.
Except for one who is a senator in Arizona and seems to be the front runner. Is there any sense that you're getting in terms of who that person is most likely going to be?
It's not clear that she's narrowed her list yet, but it is only about half a dozen people. In addition to Mark Kelly, who you just mentioned, Lisa, there's the Governor Josh Shapiro of Pennsylvania, Governor Andy Beshear of Kentucky, and Governor Roy Cooper of North Carolina. Those are the really core that we've heard speculation about, the hottest about who she might go after.
Jordan, she's going to be at an event today instead of listening to Benjamin Netanyahu. Is this the right decision for the start of her campaign, especially given the fact that she doesn't have a tremendous amount of foreign policy experience?
Yeah, it's a good question. She had a couple of previously scheduled events, so she's going to be out of town. She's going to be meeting separately with Netanyahu on Thursday, is what we're told. So, look, I think on one hand, yes, you'd like the opportunity for her to be in the room to get those photos. On the other hand, U.S. voters, as much as we care about foreign policy, U.S. voters aren't as tuned into that. And so for the opportunity for her to go out into the country, talk to voters, might end up paying off more in the long run.
Jordan, just before you go, an assessment, please, of Trump's golf game. What did you think? Putting stroke's a bit weird. I know a lot of people are saying the same thing. What did you think?
Yeah, the putting stroke is what got me, Jonathan. Left a few 8-footers short for my taste. But, as you said, decent golfer, but he says he's a 2 handicap. I'm not sure it's quite there.
Jordan, thank you, sir. Jordan Fabian there of Bloomberg. Fantastic exchange with Bryson DeChambeau, the former president, Donald Trump, if you want to tune into that on YouTube.
What does it say about our political sphere that the most authentic and passionate conversations that anyone can have in politics
Around
right now
the golf course
is about golf?
What's new about that?
I mean, well, I don't know. There was a time. I just can think back to some of the speeches that were published from the 1800s. They weren't talking about people's golf game, I'm just saying.
You know what? I think that's why people found it quite refreshing the other day to hear from Kamala Harris. It was just a normal political speech. And you might have disagreements on policy, and everyone's perfectly entitled to have those disagreements, but it just felt normal. It was somewhat refreshing. We haven't heard something like that for a number of years in this country.
She got up, she was sticking to the script, and she didn't go off veering about things like sharks or Hannibal Lecter like Trump does, but she was able to finish her sentences unlike Biden's able to do.
Yeah.
So in the sense, this was just a normal person reading a speech, delivering a message, and that a lot of people enjoyed.
That's how low the bar has been, right?
But this is exactly it. And to me, this is sort of, we talked about, what was it, boring competence over in the UK. And is that essentially what people are looking for right now in the United States, too, because they've been rather shell-shocked from some of the alternatives?
Is that what we're calling Sir Keir Starmer, British Prime Minister? Boring confidence.
Competence. Yes, well, that's what some people, it wasn't just me.
OK. All right, I'm just wondering. Wondering.
Not exactly, fireworks.
Not at all. Coming up, you don't want my opinion. Tesla's earnings falling short once again. That stock is down about 8%. Equity futures on the S&P 500 shaping up as follows. We're down across the board. We're down by about 0.7 on the S&P. On the Nasdaq 100, down by about 0.9. Bear in mind, Tesla, Alphabet make up about 8% of the Nasdaq 100. Those two names not faring too well in the pre-market. More on that in just a moment. If you switch at the board and turn to the bond market, we'll sit on the 10-year. Just check out the 10-year yield this morning. The yield just a little bit lower by not even a basis point, 4.2447. Bramo, give us the numbers. I know you've got them to hand. Supply this week.
$70 billion at 1 p.m. today of 5-year notes. And tomorrow we've got $44 billion of 7-year notes coming to the fore at 1 p.m. Eastern. Yesterday, I just want to say the 2-year auction went very well. It was oversubscribed or whatever, like it was overbid. And basically, people are looking to this idea that the Fed's going to cut sooner, partly because of the cooling economic data. So how much of a bid into duration do you end up getting, especially with the risk-off feel that you're seeing right now, led by big tech?
How much tension do you think there is between the story you just described and the fact that credit spreads are still really, really tight in high yield? Is there some tension there for you?
I would guess that theoretically, yes, because theoretically you would see credit spreads widen. There is a story in the credit world, which is that essentially over time, the credit quality of a lot of these names has increased dramatically, and the U.S. is attracting a lot of international money simply because the all-in yields are so much higher. So that's sort of a natural bid into credit that's suppressing yields. But correct, it is a little bit odd that you're not seeing investors demand a greater premium for the risk of default at a time when people say that the economy is deteriorating at a rapid clip.
Winnie Cisar of CreditSights joining us a little bit later on the programme. We'll have that conversation with her. I want to turn to foreign exchange and look at dollar yen. Every single day this week so far, so that's 3 days, Monday, Tuesday, Wednesday, stronger Japanese yen. Dollar yen now in the 154s. Lisa down by 0.6. We're back to about 154.60.
So I went looking for the reasons for this. Why exactly is this whole reversal happening? Why are people pushing back from some of their bearish views on the yen? All I could get was positioning. People kind of getting stomped out of carry trades. People basically trying to reassess heading into a couple of months. It feels as though this is more of a technical trade based on everything that I've been reading and hearing. And basically this idea that the dollar maybe is losing some of its prominence, sort of unwinding of the Trump trade, whatever you might think it was. And that seems to be more of the explanation than anything else right now.
Strongest Japanese yen since about May time of this year, after hitting the weakest level since the 1980s. Which just gives you an idea of where that currency's been. Under surveillance this morning, our top story, flight cancellations once again continue for Delta following Friday's global IT outage. US Transportation Secretary Pete Buttigieg saying the airline is now facing an investigation after more than 3,000 passengers filed complaints. Delta faring the worst among US carriers. Most other carriers, most other airlines are back on track over the weekend. Something different happened with this one. What happened with Delta?
It was the flight crews not being able to figure out where they should be. Mild problem. Also, you heard about actual pilots and flight crew members being annoyed that they couldn't call anyone at Delta to find out where they should be. I mean, this is sort of a widespread failure because of the way that they were using the CrowdStrike applications, related applications. The interesting thing to me is that only 3,000 people filed complaints because there was something like 4,500 or 5,000 people who actually had their flights canceled. Have you never had your flight canceled, been stranded somewhere, not get a voucher for anything, had to suddenly pay a whole amount of money to basically house and feed yourself for a couple of days? And you don't even know who to call? If you had a number, wouldn't you call? I'm just saying.
I'm struck by what the pilots have to say. The feeling they feel abandoned by the system. Also interesting, today by 5 p.m., the CrowdStrike CEO needs to return to Congress to schedule that hearing. He has till 5 p.m. today with those congressmen in the House to schedule the hearing because they want to know what happened, not just because people are stranded, pilots feel abandoned, but also the national security concerns of what happened with CrowdStrike.
We've seen some tough grillings on the Hill over the last few months. I'm thinking more recently of maybe the Ivy League professors getting torn to shreds, or at least the heads of those Ivy League colleges. Then more recently, the head of the Secret Service. I just wonder if that's going to be the same thing that a CrowdStrike CEO has to face and how well that CEO is going to deal with that. I've got that quote from the Pilots Union right in front of me. The inability to contact the company in any capacity. That's scathing, Bramo, scathing.
Well, and it highlights just how intricately some of these programs were worked into their system. There is a bigger question here, which is how do companies, how does a nation immunize itself from such dependence on one application in a way that could potentially torpedo its entire system? Yes, there will be a grilling with CrowdStrike CEO, but there is a larger question about how much we depend on specific companies and applications that could be systemically important and potentially destructive.
We'll have more on the airlines, on Delta specifically, a little bit later in the programme. I want to turn to the other earnings story this morning. It's Alphabet. It's down in the pre-market, a little bit softer. The numbers weren't too bad. The stock is down by 3%. Even if the numbers from the Google parent company reporting second quarter revenue and sales that actually beat estimates, but seeing weaker than expected performance from the likes of YouTube, the company also facing lingering questions over its performance against AI competitors. We caught up with a guest yesterday who said that maybe in line was the new beat. Based on that price action, I'm not sure that's the right way of seeing things.
I was actually, one thing that I wrote, in line is the new miss, at least when it depends on what the line items are. When you look beneath the hood, because they beat across the board on the top line levels. You look under the hood, what were the misses? YouTube revenue, and there was an increase in spending on CapEx related to artificial intelligence. This issue really highlights how people want to see where artificial intelligence is going to produce profits. If you can't see that path, this is the same Google that was really there a year ago when people saw it as an ad spend and a search company. And that's essentially what it displayed in the recent earnings.
Earnings season for mega cap tech very much underway. Let's turn to Tesla. Shares down in the pre-market by close to 8% in early trading with negative 7.7. The EV maker reporting another quarter of disappointing profit and confirming it's postponing the highly anticipated launch of its autonomous robo-taxi. Ben Kallo of Baird has an outperform rating and 280 price target on Tesla, and I'm pleased to say that Ben joins us now for more. Ben, in some ways, Elon Musk tried to make it very simple for us all. Either you believe in the robo-taxi business and you should be in this name, or you don't and you should sell. Ben, do you see it the same way? Is it that simple?
I think that there is some truth to that. I also think that we have some more near-term things that we can hang our hat on. The next generation vehicle, which we do think will be unveiled at the robo-taxi event. Tesla hasn't had a new vehicle on the road outside of the Cybertruck in that small volumes in several years. And so as we get a more mass market vehicle or vehicles as early as next Q1, I think that will be a catalyst for the stock. And I think that, reiterating the timeline around that vehicle was a very important part of the call last night. It was a bottom line miss. The margin, people are going to argue over regulatory credits, and they beat on the margin. If you had the regulatory credits, they missed. If you didn't, their experience, some pain that the other auto manufacturers are also experiencing. Tesla does have the balance sheet over $30 billion. They managed to generate, over $1 billion of cash flow, even with investing $3 billion of capex and R&D during the quarter. And so, I buy the dip here because we're set up for, many different growth opportunities, energy, Optimus, full self-driving, and then the next generation vehicle.
Let's talk about the slippage around the timeline for autonomous driving and the robotaxi specifically. Let's go with the robotaxi. It was meant to be unveiled in August, Ben. It's been pushed back to October. We had that reporting in the last couple of weeks, basically confirmed yesterday in the release. Ben, how material is that for this company? Because I've been describing it since April as the carrot over this stock, and maybe the people doing so, including myself, were wrong, because it was being pushed back and it doesn't feel like that's the big driver here. How important is that to this story at the moment, Ben?
Well, Dana Hall and Bloomberg did a very good job of breaking that story. I think at the bottom line, though, it pushed out 2 months, and I think it was a twofold. One, they wanted to tweak the robotaxi itself, in the platform, so needed more time in that. And then also, like I mentioned, the next generation vehicle, it matches with their timeline of getting those cars out on the road at the beginning of next year. So to unveil it in October makes more sense than in August, where you have the potential to damage sales of the Model Y and the Model 3 with introducing a better new product. And for tech companies and tech investors, you want to be buying ahead of new product cycles, and we're right here in front of a new product cycle.
There's a question also about how quickly it can get rolled out in any kind of mass to create the profitability that a lot of people would need to see. There are concerns about regulation, especially with a full self-driving as well as robotaxi technology. In response to that, Elon Musk on the earnings call said this: "I don't think regulatory approval will be a limiting factor." Do you agree? Is it not a concern to you either?
Well, first, just the rollout, we expect it to be, in select cities in a Tesla-owned fleet. So taking small steps, but those small steps will have big implications for valuation. As soon as investors can wrap their arms around what this is going to be, start modeling it out, and then see the future profits that can be generated from this, then they start ascribing a valuation to it. We don't actually do that in our price target in our model. And so when we get there, we get a framework for it. I think even though starting small, might disappoint some people, I think it will also attract a lot of investors that can start, dreaming the dream that is becoming more of a reality every day.
Ben, we heard Elon Musk weigh into politics again last night. He said Trump has said that he'll put in heavy tariffs on vehicles produced in Mexico, so it doesn't make sense to invest a lot in Mexico if that's going to be the case. Who do you think is better for Tesla in the White House? Kamala Harris now or Donald Trump?
Well, I think that Elon has put himself in a position where both are better. Both are good. He has strongly endorsed Donald Trump. He has donated to a PAC supporting Donald Trump. And so he has the ear of Donald Trump. And so as it pertains to renewable energy, as it pertains to electric vehicles, he has that ear. And you've seen that Donald Trump has changed his tone quite a bit since that endorsement. Saying that he likes EVs, and that was, a far cry from what he was saying a couple months ago. And then Kamala Harris, as part of the Biden administration that put in arguably the largest energy plan that we've had, at least in my lifetime, in the Inflation Reduction Act. And so I don't think, I think that will stay status quo. And so that, I think they can thrive under both administrations.
Ben, I want to just dig a little bit deeper into that. Are you basically saying that Elon Musk's support of Donald Trump has essentially succeeded in creating him favor so that if Donald Trump becomes president, any types of policies that a lot of people think could potentially take away certain benefits for electric vehicle makers would get rolled back, at least for him, and that tariffs wouldn't be as punitive?
Well, I think that, one mistake that the Biden administration made was, they never visited Tesla because it's non-union. They visited other auto manufacturers in the United States. I think having an administration that is open to talking to Elon Musk is better for them. I don't think that, they're going to favor, Tesla over other auto manufacturers in any way. They may tighten up the way that, materials need to be in the United States, produced in the United States, whether it's lithium or other materials. And Tesla has already taken those steps to move their supply chain into the United States. So a domestic supply chain that I think would thrive under the Trump administration.
Ben, thank you, sir. Appreciate your view. Ben Kallo there of Baird. The takeaway, he says, buy the dip. The stock is down by close to 8% in the pre-market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. Santander shares are rising 1.5%. The Spanish lender reported net income for the second quarter that beat expectations. It also upgraded its outlook for efficiency and revenue growth this year. The bank is on track to roll out a new tech platform that's intended to lower costs across all units. Spain and Brazil boosted results for their key retail business. Brazilian locations in particular benefited from rate cuts. And what's old is new again. Apple is reportedly working on a foldable iPhone that could be released in 2026. Tech news outlet The Information says the firm had reached out to suppliers in Asia to make components for the device. The phone would reportedly fold widthwise like a clamshell, making it similar to the Samsung Galaxy X Flip, which was released in 2020. The report says that Apple had created an internal code for the product, signaling that the idea has moved beyond the conceptual stage. And there is some good news if you're still looking to travel to Paris for the Olympics. According to travel insights company Lighthouse, hotel prices for the Summer Games have fallen to almost half of their peak rate. Accommodations are now being listed on average of $340 a night between this Friday and August 11th. That's down 41% from the peak rate of $575 around 11 months before the Games. Opening ceremonies are this Friday. And that's your brief. John.
Danny, thank you. Next to no interest in being in Paris for the Olympics. No interest
Really?
at all. And clearly, based on the hotel prices and the trajectory for them, people share that view.
Well, they aren't as interested as people previously thought. They're still high, and people, there's one person, Jim Reed over at Deutsche Bank, talked about how he's going, but
Is
he's
Jim
not going to
going?
waste.
Okay.
Yeah, he's going to bring his family over the weekend.
And the
Good for Jim.
prices of LVMH
Go,
goods
Jim.
in Paris versus you could be going to Japan instead.
Exactly. Or Italy. I always think that. I'd rather go to Italy. Like France's budget Italy. That's how I feel about France.
I actually was looking at some of the events.
Not interested.
That's pretty harsh, but I will say table tennis, judo. I was looking at some of the events that you could go to. There's a wide panoply of potential events.
There we go. We'll check it out. Try and get some tickets, Bramo. Team tour. TK would love this, wouldn't he? He'd make it happen. Up next on the program, big tech facing big expectations.
Over the next kind of 4 to 5 months or so, expect to see some bumpiness, some consolidation, at least from some of those tech gains out there. Clearly kind of gotten a little bit ahead of themselves.
That conversation up next, live from New York. You're watching Bloomberg Surveillance. Equity futures on the S&P 500 negative here by 0.7%. A couple of disappointments out there. We'll talk about them in just a moment. Under surveillance this morning, big tech facing big expectations.
Over the next kind of 4 to 5 months or so, expect to see some bumpiness, some consolidation, at least from some of those tech gains out there. Clearly kind of gotten a little bit ahead of themselves. As we kind of start exiting the calendar year here, we think there will be kind of another boost up there, or next leg up here for big tech. But right now, I think some consolidation is probably warranted.
So here's the latest. Shares of Alphabet falling in the pre-market, down by a little more than 3%. The Google parent company reporting second quarter revenue and sales that came in above estimates, but investors focusing on disappointing results from YouTube and lingering questions over the company's progress on AI. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, one of those releases that if you hadn't showed me the price action, I would have guessed the stock was sort of flat to up. I'm surprised it's down. Are you?
Absolutely. It was a solid quarter. The only negative was the YouTube and the CapEx increase. But look, I think they quantified the cloud revenue and the AI contribution to that. And that was a big positive because everyone right now is focused on how much can you generate from AI workloads on cloud. And that segment also saw an increase. So to me, this was a very solid print. I mean, clearly, market is focused on CapEx and free cash flow, but it's noise. I think this will pass.
There was a really important quote that came out of yesterday, and I think it is important. The risk of underinvesting is greater than the risk of overinvesting at the moment. Can you build that out for us? What were the leadership at Alphabet trying to communicate here?
That this is a long runway in terms of, what you can do on the AI side. And they're actually doing it at scale. Think about it. Search, they have 90% share. Everyone thought it was a saturated market, and they're now growing mid-teens. And they are doing it without any impact to the gross margin. That's a remarkable part because everyone thought AI queries would be more expensive to run, it would hit their gross margin. Well, guess what? They're able to apply the right kind of model to the right query, and that's what shows up in their gross margin. I mean, Perplexity, ChatGPT, all the competition that everyone talks about in search has had no meaningful impact on their query volumes or their gross margin.
One reason, and John mentioned this, that there's this feeling right now that maybe Google doesn't have the internal capacity to create the artificial intelligence programs to adequately compete with others who could potentially, I'm thinking of Microsoft and Binging, they could potentially supersede them when it comes to their base search. Do you think that based on what we've seen, they are moving at a fast enough pace with the personnel needed without making an acquisition that's proved to be somewhat difficult for them to do?
Yeah, I think acquisitions, it'll be very hard to get that, done simply because of the regulatory scrutiny. But Google's business is they've got 9 apps with over 1 billion monthly active users. Just think about it, in terms of family of apps. What kind of scale do they operate at? And when it comes to large language models, everyone talks about, okay, these models are intelligent, they can reason, they can generate content. Where do you link the content? You have to link it to Maps, which Google owns. You have to link it to YouTube. The final output of search is something that you want to link to make it easy for the user to be productive. And Google's own those assets. So to me, that's a big plus. Even if they may not have the best large language model, the fact that they own the underlying assets that everyone wants to link to in terms of internet usage, that's a big positive.
So you're pointing out a lot of reasons for the stock to have rallied after yesterday. And frankly, we are not seeing that, which really raises this question. Is this a time when, after a 30% rally in the shares so far year to date, essentially an inline is not a beat and a raise, but an inline is a miss and a reason to shed some exposure at a time when it still is unclear how quickly some of that can be monetized?
Yeah, I think the AI number that they gave in the cloud segment, which they quantified, it's almost high single digit, 10% of their cloud revenue. Microsoft said the same last quarter. So to me, that clearly shows they are gaining in cloud. And look, when it comes to how market perceives their, LLM leadership, they will realize over time that this company's underlying assets are a big moat that nobody can supersede. And look, right now, CapEx is a big focus. You will see that with Meta when they report. If they raise the CapEx, the reaction will be negative. So that's what the market is focused on, is if you're raising CapEx, that's lower free cash flow. And that was a reaction.
This is important for next week. Are you saying this is going to be punished next week when we hear from those other companies?
Absolutely. With Meta, and most likely they will raise their CapEx. They just released their latest version of the Llama model yesterday. And Mark Zuckerberg said he wants Llama to be the most used AI assistant. Guess what? They will raise their CapEx. And I think the market reaction will be negative.
There is this larger question kind of hanging over this reaction, which is, are we overestimating how quickly artificial intelligence can be applied and monetized? Is this sort of an implicit understanding that's been priced into markets prematurely?
I mean, right now, we don't know if the larger models, so GPT-4, let's say it took $200 million to train. Will GPT-5 take $1 billion in CapEx to train? Or will it be along the lines of GPT-4? And will GPT-5 have sufficient, improvement in terms of if you compare it to GPT-4 reasoning? If that is the case, we keep going higher in terms of CapEx. So until we hit a cap in terms of, the model improvement, the CapEx will keep going up.
When you look at YouTube in the next 100 days or Meta, what are you seeing in terms of advertising spending? So we had an analyst on yesterday from BNP Paribas who was a little bit uncertain about advertising because of how toxic really the political environment has become.
Well, typically in an election year, political ads are a tailwind for all these internet platforms. And I expect the same. The question here is, brand ads was weak for YouTube, and you have to ask, what are the verticals that didn't spend? They called out retail and financial services as verticals that did increase the spending, but maybe other verticals in the economy aren't spending as much on ads. So to me, this is a barometer of how good digital ad spending is, and typically lower inflation is good for digital ad spend.
We just wanted a final word from you on the cybersecurity startup Wiz, basically saying no to Google. Typically, we think about M&A in this particular part of the world breaking down because certain people in Washington, D.C. don't want it to happen. What's the kind of signal that you take away from the fact that it was the startup saying, no, thank you, we're going solo?
I mean, this was just a case of bad timing. Had the CrowdStrike outage not happened on Friday, we would be talking about a deal going through. Literally, yes. Just because it makes sense. Google had the best shot of making an enterprise-related acquisition, and cybersecurity actually complemented their cloud offering. And I think regulators would have let that through. But clearly, the company said no because they think they can garner a higher valuation.
Do you think they can, based on what happened with
If they were to go
CrowdStrike?
public in the next 3 months, they would.
Amazing.
Just because I think CrowdStrike will be losing business right now.
Amazing. Mandeep, thank you, sir. It's good to see you. Mandeep Singh there of Bloomberg Intelligence on the latest for tech, with a little bit of a sneak peek, a preview of some of the big names reporting next week as well, with Meta Bramo on deck, alongside the rest of them, Microsoft, Amazon, Apple, and pretty much everyone else.
And I wonder if maybe the signal that we can get here is to look at how much share prices have gone up so far this year and then determine how high the beat and raise has to be in order for those shares to pop following the earnings. Because right now you're looking to a lot of positivity being baked into Google shares. How much is that really what's being punished more than the actual earnings, which actually beat expectations?
In the pre-market right now, Alphabet down by about 3%, Meta down by about 2%. And to your point, over the last year, those stocks absolutely flying. Coming up next on this programme in the second hour of Bloomberg Surveillance, we'll catch up with Kate Moore of BlackRock, Aaron David Miller of the Carnegie Endowment for International Peace, Stephen Trent of Citi, and Winnie Cisar of CreditSights. If you are just joining us, equity futures on the S&P 500 pulling back by 0.7%. On the Nasdaq by more than that. Yields just a little bit lower. We're down about a basis point in the 10-year at 423.88. And once again in foreign exchange, the dollar is weaker against a stronger Japanese yen. 3 days of this. Dollar yen right now pulling back to 154.53. From New York, this is Bloomberg.
The Fed is late. They need to be cutting already. They should have started cutting some months ago. So, yeah, we're pretty aggressive on this, but it's really driven by the inflation forecast.
Inflation is gradually trending down, but we'll have likely a few bumps along the road.
The Fed, I think, has changed the balance with regard to how they're looking at things. And I think that the market is catching onto that.
The contrarian bet really that we have is that if the Fed cuts in September, it wouldn't necessarily be a good thing.
The problem in the short term is that we've priced in the rate cuts and the economy slower.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City for our audience worldwide. Good morning, good morning. Here's the price action you're confronting this morning. We're down about 0.75% on the S&P 500. On the Nasdaq 100, pulling back by 1 full percentage point. The price action disappointing relative to the numbers from the likes of Alphabet, which weren't bad. Tesla, the numbers not great. That stock is down by about 8% in the pre-market. The story I want to talk about is on the Federal Reserve and a big change from a former Fed official. The former New York Fed president, Bill Dudley, coming out and saying, "I've changed my mind. The Fed needs to cut rates right now. It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk."
Which raises the emphasis on jobless claims on Thursday, because he points to the labor market in particular that has increasingly weakened, at least in terms of the peripheral data. We're also seeing housing data yesterday coming in pretty negative. And right now we're seeing markets price in almost a 100% chance, 96% chance of a September rate cut. Will that get brought forward? Right now, the market's saying not likely.
Bill Dudley also talking about the bifurcation in the U.S. consumer. He's talking about those on the lower threshold. The rest have generally depleted what they've managed to save from the government's huge fiscal transfers, and they're feeling the impact of higher rates on their credit cards and auto loans. Housing construction has faltered. This is why he really thinks that they need to cut rates. The steam, all that tailwind coming off the U.S. fiscal spending has dried up.
You can identify the cracks. You mentioned housing. Let's build on that. The numbers that came from Redfin, a brokerage with some data just yesterday. Nearly 56,000 home purchases were cancelled last month. That's equal to about 15% of all homes that went under contract that month. The highest share of cancellations for June in the brokerage's data, going all the way back through 2017. Can't miss that.
The reason why it's so important is because of the speed. That suddenly people enter deals that they want to break. Why? Because of, quote, minor issues, because of the monthly costs associated with buying a home today versus their overall expenses. Meanwhile, we also get news this morning about the Blackstone mortgage REIT actually cutting their dividend. This follows cutting the dividend of KKR and Ares funds of similar ilk, as property values, particularly office property values, plummet almost 40% since 2022, according to some data. So you look at all of these headwinds and you wonder how much has actually come to the fore and how quickly could weakening happen as some of these shoes just start to, loosen up a little bit.
From Redfin, what stands out to me is house hunters are having trouble committing because buying a home is more expensive than ever. This is why the former president told us in that Business Week article that they should not be cutting rates before November, because this is an election issue. Mortgages, the fact that people cannot get on the housing ladder because it's just too expensive. This is going to be a hot topic. And if they cut twice before the election, it's going to become very political.
We'll hear from the sitting president, Joe Biden, a little bit later on this evening, 8 p.m. Eastern Time. Look out for that. I want to turn to the price action. Equity futures on the S&P 500, negative here by 0.75%. Pulling back, yields a little bit lower, down about a basis point. The 10-year 423.88. The euro just a little weaker, dollar stronger here, 108.41 on that currency pair. The data out of Europe this morning, once again, not great. PMI's really not great at all. We'll pick up on that theme a little bit later. Coming up this hour, we'll speak to Kate Moore of BlackRock following a disappointing start to big tech earnings. Stephen Trent of Citi as Delta faces fallout over flight disruptions. And Winnie Cisar of CreditSights on the state of the US consumer. We begin with our top story. Alphabet and Tesla results failing to impress investors as earnings season continues to ramp up. BlackRock's Kate Moore writing the following. Early reports suggest a potential continuation of first quarter trends. Auto, industrial, cyclicals, not yet out of the woods. Consumer spending remains tepid, and companies with positive earnings momentum into a slowing economy will be rewarded. Kate joins us for more. Kate, let's talk about the theme, and welcome to the show. It's been too long, as always.
Yeah,
let's get straight into it. Good to see you. The small caps ripping in the last couple of weeks. You don't think it's that durable. Let's start there. Why not, Kate?
Yeah. I mean, we could have like a whole conversation about this, John, but there are a few reasons. I think the most primary reason here is that small caps tend to perform when the economy is improving, when the second derivative of economic growth is positive. And we're at a point right now where I think we can all agree the economy is slowing, maybe not at a dramatic pace at this point, but in such a way that the Fed should be able to ease policy rates sooner rather than later. And that environment, that slowing economy, is not generally good for companies that are price takers, that are in lower on the supply chain, and that tend to not have the diversity of businesses that their large and mega cap peers do that cushion them through different parts of an economic cycle. I also want to point this out, because people have made the small cap argument around the debt profile. Hey, small caps have a lot of floating rate debt, and that's going to be great when the Fed starts cutting rates. Well, they need more than 25 or 50, or in many cases, 75 basis points of rate cuts before it really has a significant impact. And I want to note that a lot of the debt for the small caps comes in the form of bank loans. And we need banks to feel confident enough about the economy to be extending those loans to the small companies at the same time. So I think this is a tactical, technical, and sentiment-oriented play, and not really based on the fundamentals of small companies.
It also is based on valuations, Kate, at a time when you're still seeing some of the big tech names really garnering some pretty high elevations. You've been overweight some of the AI names, some of the big tech darlings, and even you seem to be cooling on the margins about just how much further they can go. Can you explain this sort of bifurcation of not being particularly positive on the small caps, but also sort of seeing some of the large cap beloved stocks losing some luster?
Yeah, you're right. It is a little bit of a tricky point, and I hopefully want to get to a point in the fall where our view changes a little bit. But we've been trimming a little bit of our what had been a very significant tech overweight over the course of the last number of weeks, since it's really kind of late spring. And much of that has to do with the incredible performance we saw in the first half of the year. And as you point out, we've traded at premium valuations for lots of these stocks. We don't actually think most of these AI-oriented companies are going to have trouble with their earnings. Remember, they're later reporters. They report kind of late next week or in through August. I think those are going to be the real show me moments for the theme. That said, when we're at these kind of price to perfection levels and we're at such huge premiums to other parts of the market, it's just good risk management to trim a little bit. I just also want to emphasize, though, that our enthusiasm for the AI theme has not diminished. This is more of a tactical and portfolio construction move that we've made.
Which might explain why other people seem to have a similar kind of sentiment, at least based on the price reaction to Google shares after their earnings that were largely better than expected. Just when you dial this forward, if you're marginally selling some of the large cap names and you're not buying small caps, what are you going into?
Well, we've kind of marginally sold a little bit on the AI and tech-oriented names, but we've done a little bit of sector rotation. Nothing dramatic. We're not buying into sectors we don't have a lot of conviction in. I would say we're not adding to consumer staples at this point. But, we've been selective around banks. I think there's some opportunity there. We see some very high quality balance sheets and opportunities. We see some opportunities across energy, stuff that has gotten exceptionally cheap. And we're going to continue to kind of monitor both the growth story that could impact energy as well as the policy side. And then I would say there are parts of consumer that we do like. And we are being selective there. You mentioned just a moment before I came on that there has been very mixed news, particularly for the low-end consumer. But there are consumer companies, maybe experiential consumer companies, or those with very specific and well-loved brands that we think can be resilient even in a slowing economy. So let's just say this. We're being more selective, and we're kind of trimming on margin stuff that has run very, very hard, but not giving up on the theme.
You named a range of sectors. One I just want to tease out and build on that, and then we can go to others. Kate, energy. And you mentioned some policy considerations. Can you go a little bit deeper? How are you thinking about that sector?
Well, I mean, energy has the potential to look quite different in 2025 under one administration rather than another. And we're going to be paying very close attention to what happens in the November election, not just the presidential level, but also at the congressional level, and kind of how the tone might change towards traditional energy versus renewable energy, and which parts of that complex have the best legs for the next couple of years. I will say, even though we're talking about slowing growth, we're not talking about catastrophic growth. So we think there's underlying overall demand for traditional energy. And we've continued to see that type of capital discipline that we've talked about many times in the traditional energy companies, which is leading them to look fairly profitable and to generate cash. So there's a lot to do there. And I think it's kind of an interesting and exciting sector given potential policy changes in the US and elsewhere. And that may lead to some rotations within the industries in the sector.
Kate, can you just drill down into exactly what you're looking at and how the rhetoric potentially can mean an investment decision? Because under Biden, energy stocks did do well, and we're pumping at least crude natural gas, the most any country has ever produced on record, even though the former president, Donald Trump, says he's going to unleash America's liquid gold. So how do you put some of this rhetoric into a position?
Yeah, I mean, I think this is a great point. In any political cycle, there is a huge gap between narrative and reality. And when it comes to energy, you pointed this out very well, there was an enormous gap between negative rhetoric and actual reality. So here's what I will say. We have to understand what the consensus thinks. We need to understand how people, not just ourselves, are interpreting policy. And we need to position ourselves around that, not just around the real impacts of policy. It's kind of like the second derivative. It's understanding behavior, it's understanding sentiment, and it's understanding how people have gone into changes in rhetoric and the narrative in terms of their positioning. So it's a little bit of art, I would say, and this is kind of one of the fun parts of investing. I think there are lots of parts of policy outside of energy, for example, that could look a little different in 2025 under either administration. We've been spending a huge amount of time, and there's a lot of the street been talking about one set of trades versus another set of trades. I have to say, I think it's premature. I've made this point multiple times, and I'm going to just underscore it again. Congress matters. And at this point, we don't have a great sense for how the down ballot votes are going to go. And if we have a sense, let's say at the end of November, for what the composition of Congress is going to look like, what kind of policies could actually be enacted, I think it's going to be an easier time to put on a more specific U.S. policy trades than today.
You've got to wait. Kate Moore of BlackRock. Kate, thank you. Appreciate it. Thank you very much. I think we noticed that from a lot of Southside research houses over the last few days, following the decision by the President of the United States to step aside. The endorsements we've seen come through for the Vice President, Kamala Harris, that many institutions didn't change their mind about who was going to win the election in November, but they did put big question marks around what would happen with Congress.
What was more interesting to me was not so much what happened yesterday with Kamala Harris in Wisconsin, was that Tammy Baldwin, the senator who's vying for her re-election for that seat, showed up. She didn't show up a few weeks ago when Joe Biden was in the state because it would hurt her. What did Alyssa Slotkin say to donors? Trump is winning in the state and it's hurting me. Now that you have a different top of ticket, does it help down ballot?
My favorite part of her conversation was the psychology of just sort of understanding
Yeah.
how people understand policy, the sort of second derivative aspect of it, and sort of gaming out what they think might be the case.
What you think's not important.
Not at all. And I love that, because to me, trying to get a handle on what other people are thinking right now is just as challenging as trying to get a hand on policy that's somewhat elusive.
That's the art of the next 4 months that's going to drive everybody nuts. Equity futures on the S&P pulling back by 0.75% with an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. AT&T saw a second quarter subscriber increase thanks to ongoing promotions and a lower churn rate. Shares, you can see there, higher by more than 2.6% in the pre-market. AT&T had its first year-over-year increase in new monthly phone subscribers. The number of cancellations fell, likely in response to a marketing push that gives new and existing customers the same deal on new phones and plans. Southwest Airlines is facing enhanced scrutiny from U.S. regulators over a series of recent flight safety incidents. The FAA has launched an audit to review events, which include a flight that came within 400 feet of plunging into the ocean off Hawaii, and a plan that took off from a closed airport runway in Portland, Maine. The carrier said it has already formed a team, including airline leaders, pilot union members, and the FAA to identify opportunities for improvement in its safety management system. Aston Martin shares are higher in the London trade by more than 8%. The British car maker saw strong demand for its pricier limited edition supercars. Aston Martin delivered 118 of its special models in the first half of the year. That compares to 38 last year. It was led by Valkyrie and Valor models, which cost at least $3 million and $1 million, respectively. That helped boost the average selling price, offsetting what was otherwise a drop in deliveries. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Just got a message. Neil Dutzer, Renmac. Nice to see Dudley coming around. That just dropped in the inbox just now. You know, I think a lot of people come into this view that maybe, July should be a real consideration, which has been Neil's view for a number of weeks now.
Which, again, is the reason why people are looking at some peripheral data like the housing data yesterday and putting more emphasis on it, because it confirms the current narrative of a more protracted weakening.
Up next on the program, Netanyahu making his case on Capitol Hill.
I would like to hear him talk about what he plans to do to end this war. I would like to hear him say that he's going to initiate elections in Israel so that the Israeli people who have been demonstrating against his leadership understand that there's the potential for an option.
That conversation coming up next, live from New York City this morning. Good morning. Equities negative here by 0.75% on the S&P. Yields just a little bit lower, down a basis point. The 10-year 423.69. Under surveillance this morning, Netanyahu making his case on Capitol Hill.
I would like to hear him talk about what he plans to do to end this war. I would like to hear him say that they're going to increase humanitarian aid to all of those Palestinians affected in Gaza. I would like to hear him say that he's going to initiate elections in Israel so that the Israeli people who have been demonstrating against his leadership understand that there's the potential for an option.
It's the latest this morning. Israeli Prime Minister Benjamin Netanyahu speaking before Congress at 2 p.m. Eastern today, where he's expected to try to shore up support as the war in Gaza continues. Netanyahu set to meet with President Biden and Vice President Kamala Harris separately on Thursday, followed by a meeting with Donald Trump on Friday. Aaron David Miller of the Carnegie Endowment for International Peace joins us now for more. And I want to get to this question. President Biden is a lame duck president. We all understand that. Do you think that gives him less space to deal with the likes of Netanyahu, or more space to find an agreement?
I mean, look, I think from the beginning of this conflict, thanks for having me, John, the tone, the trajectory, the motives, the calculations, escalation, de-escalation have been set by the two major combatants, Israel and Hamas. If there is a deal, and I suspect there's a reasonable chance by mid-August that you actually could achieve one, I think it'll have more to do, frankly, with changing calculations on the part of Hamas and or Israel, particularly Mr. Netanyahu, than it will be with American pressure on one hand or American persuasion on the other.
Aaron, we have commercial ships in the Red Sea still under threat. We have 5 Americans still under hostage from Hamas. What kind of deterrence do you see from this administration currently?
I think, and there are many feelings about the administration's policies toward this war, but I think the one issue that they've been relatively successful on is preventing what I would describe to you as a major escalation. Certainly, the Houthis are going to remain a problem. I mean, they are a keeper. There's no question about it. They are, according to some analysts, the southern Hezbollah, and they've demonstrated that they have reach. They launched this Samad drone 1,300 miles from Yemen into downtown central Tel Aviv. Not even Hezbollah has done that. So I think the administration has to deal with a certain number of realities, and one of those is that Iran has benefited greatly from the use and exploitation of their proxies. And there's very little, frankly, pending some transformative agreement between the U.S. and Iran, highly unlikely, certainly between now and the end of this administration, or probably for the next. So that's a problem that the United States has no solution to, and it's going to have to try to manage to the best of its ability.
It feels like we continuously see red lines crossed when it comes to this conflict, but especially when it comes to Iran. What is the policy currently from the Biden administration?
Management and de-escalation. And look, in fairness to the administration, frankly, any administration, I work for a Republican and Democratic administration, we have a strategic problem with Iran, both on the nuclear side and with respect to their use of proxies in the region. And we have no strategic solution. The reality is you have a regime that is highly ideological and dangerously pragmatic. It's expanded its reach now in creating a virtual alliance with Putin and his war against Ukraine. It's backed Hezbollah, the Houthis, Hamas in Gaza, at little cost and expense to itself. The Iranian problem, unless there's a change in regime, in my judgment, is going to be a management problem. It's not pretty, it's not emotionally satisfying, but frankly, it's a cruel reality. I just don't see the alternative right now.
So given that that's sort of an ongoing simmering issue, looking inward, you've worked with both Republican and Democratic administrations when trying to manage this situation and the implications for Israel. Have you ever seen such a big divergence between Republicans and Democrats in terms of support for Israel?
I mean, I think you really broke the code. You have a degree of polarization and the fracturing of bipartisanship that is unprecedented in this relationship. The Republican Party, and again, I voted for Republicans and I've worked for Republicans, maybe not these kinds of Republicans, but the Republican Party has emerged as the Israel can do no wrong party. And the Democratic Party is split, not just between progressives and mainstreamers. You have mainstream Democrats, Chris Coons, Chris Van Hollen, Chris Murphy, who at one point or another over the last several months have publicly called for conditioning military assistance to Israel. So what is at stake here? I think literally, for the first time in the history of the U.S.-Israel relationship, is a debate between Republicans and Democrats and within the Democratic Party about what it actually means to be pro-Israel. And that, for anyone who is interested or cares about a strong, healthy U.S.-Israel relationship based on reciprocity and trust, that is a very worrisome development.
So what is a pro-Israel point of view from the Donald Trump camp versus the Kamala Harris camp?
Well, I think you look, all presidents are blind dates, right? So no matter what their resumes are, when they get to the White House, they essentially are going to be tested. You've had 4 years of a trial run with Donald Trump. And again, I'll say it again. I voted for Republicans and Democrats. I've worked for Republicans and Democrats. I think it's fair to say that Donald Trump, whose conception of the national interest, frankly, is transcended by his own personal interests, and tethering to his political interests, created what I would call, as a believer in a strong U.S.-Israel relationship, a sort of a sugar high for Israel. A series of goodies, pro-Israeli gestures, and policies which were very pro-Israel and appreciated certainly by Benjamin Netanyahu, with whom the former president has a sort of Vulcan mind meld. But on balance, the Trump administration, even though it deserves credit for the Abraham Accords, also had no serious, significant policy or approach to managing what I think is probably the greater challenge that the Israelis face, and that is what to do about the Palestinians. You have 15 million humans, and let me deploy river to the sea here in an educational context. You have 15 million humans living between the Mediterranean Sea and the Jordan River. What are you going to do? How are they going to coexist? In my judgment, the only rational, even though it's more attuned to a galaxy far, far away than back here on planet Earth, is separation through negotiations. And the Trump administration took an approach on the Palestinian issue, which essentially discounted it as a factor. And I think we see year after year after year that this problem, the Hamas terror surge, brutal Hamas terror surge, is not a manifestation, in my judgment, of what the more rational elements within the Palestinian community want and believe they can actually achieve for their people. So focusing on Palestinians, I think, is critically important, however grim the future of a two-state solution is right now.
Aaron, we've run out of time. That was deeply thoughtful. The subject has always been polarizing. It is even more so in 2024. Aaron David Miller of the Carnegie Endowment for International Peace. Interesting where Kamala Harris won't be a little bit later on today.
She will not be at the address by Netanyahu. Instead, she's going to go to a pre-scheduled event addressing a sorority in Indianapolis. And I have to say, from the foreign policy, national security world, this is getting a lot of pushback.
Live from New York City. Coming up next, Stephen Trent of Citi will pick up on the fallout of Delta's cancellations. If you are just joining us, welcome to the programme. We are about 2 hours away from the opening bell. Just a flavour of the price action for you, starting with the S&P pulling back by 0.6%. On the Nasdaq 100, down about 1 full percentage point. We know what's responsible for that. If you add up the weightings of, say, Alphabet together with Tesla, you're talking about 8% of the Nasdaq 100. And both of those names are down in the pre-market. We'll pick up on those earnings in just a moment. I want to turn to the bond market, sit on the 10-year. Yields at the moment on a 10-year down by about a basis point or two, 423.49. The headline this morning, not from the earnings, not from the data, from a former Fed official. I think we have to sit on this quote from a former Fed official, and that former Fed official is the former New York Fed President, Bill Dudley, saying he's changed his mind. The facts have changed. His view has changed. Although it might be too late to fend off a recession by cutting interest rates, dawdling now unnecessarily increases the risk. He thinks they should make a move. And Lisa, we've been talking about this for a number of years. Bill Dudley is no Uber dove. He was very, very hawkish and thought this Fed should get a move on a long time ago. And he was talking about 5 when I have to say hardly anyone was talking about 5% interest rates. And up until recently, he was saying there's a risk of inflation staying sticky, maybe even reaccelerating. This is a big change. And when you go through the body of this piece on Bloomberg Opinion, this opinion is built on his view of what's developing in the labour market. And that's front and centre for a lot of economists at the moment.
Which is the reason why, and we talked about this earlier, jobless claims are going to be really important. Initial jobless, ongoing claims, the idea that that's risen to the highest level since 2021. How quickly this is deteriorating. That's why the Redfin data was so interesting that you pointed to. Deals are collapsing at a record pace in the housing market because people are assessing their monthly costs and wondering what they can actually afford. There is this feeling that things are deteriorating at a faster clip, maybe not falling off a cliff, but maybe signaling a bit of a change in the economic cycle.
Feels like things are starting to pause, just across different issues, housing being one. I'm thinking of another, let's say, Tesla, Elon Musk saying, I'm not going to make that investment in Mexico until I know the outcome of November. That note from Goldman that we started the program with on China, I think, is notable as well. Basically suggesting over at Goldman Sachs that China is holding back on fiscal stimulus to wait and see if they get a Trump shock in 2025 that they need to respond to. Just a lot of pauses that you're seeing across the board here.
And a lot of pauses from just consumers making certain purchases. And again, you talk about how difficult it is to read this earnings season. GM comes out with better than expected earnings because they're selling trucks. And yet dealer data shows that they're actually providing the greatest numbers of incentives for cars more broadly to move them off the lot. You're seeing in the EV space a real weakening. So right now, you can't really get a clear read, but the pockets of weakness are being shown in many more corners.
And what happens in the United States, what does that mean? How does that reverberate around the world? Bernard Arnault today, also in his statement, talking about this uncertainty when it comes to economic and geopolitics. I feel like the C-suite has finally this week basically woken up to the concerns and the political uncertainty ahead of November 5th, which basically says to me these decisions are not going to be made until they have a clear-cut view on not just the White House, but the composition of Congress as well.
Without a doubt, it's about the policy in 2025. And for a number of months, we've had a key phrase on this programme, flying blind into 2025. Let's finish on foreign exchange. Another day of Japanese yen strength for you. Dollar yen pulling back for a third consecutive session. We're down to about 154, 154.45 and negative 0.75%. 3-day streak of yen strength. Haven't had one since early May. That's how bad the Japanese yen story has been through 2024. That's foreign exchange under surveillance this morning. Our top story, President Biden addressing the nation tonight at 8 p.m. Eastern from the Oval Office. It will be his first on-camera address since he ended his re-election bid on Sunday. Biden has been isolating at his Delaware beach home since last week when he tested positive for COVID-19. He's had a few days. I understand they've been writing this speech for a while. What are you expecting to hear?
Well, we need to see the President of the United States. He has told us on 3 different occasions he was staying in the race unless 3 things. The Lord Almighty came down, data, if we saw in the polls, someone said you couldn't win, or if there was a serious health concern. Then all of a sudden he releases a letter on Twitter without addressing the U.S. He's a sitting president. He's not seeking re-election. This does not normally happen, and we should be seeing the President of the United States. So I just want to hear why he has changed his mind. Was it the political pressure? Does he feel like he cannot serve out his term, serve out another 4 years? But does that mean that he feels up to the job until the remainder of the year?
People are just going to be looking at the tone. They just want to see that he's actually really going to come out with a strong message of support for Kamala Harris, but also does seem cogent to that point. The idea of just being a presence that can remain in office for the remainder of this year.
There's so much criticism coming from the right. And we've all heard the question being asked a million times. It was being asked up until Sunday. It's being asked after Sunday as well. If you can't campaign, if you can't run, can you govern? So really, it's the right. They're going to put even more pressure on. If we have a shaky address again this evening, you'll hear more calls for that. Look, he's had a 50-year career in politics. He deserves a graceful exit. And let's hope he gets one over the next few months. The policy issue here for the next 6 months is what really interests me. I wonder how much space he has just to follow his political instinct around issues like Israel now. Given the fact that he doesn't have to worry about campaigning, he doesn't have to worry about November, he doesn't have to worry about the progressives anymore, he can just follow his political instinct in a way that he might like to.
Potentially he'll lean a little bit more into Israel because you can already see this week 2 separate meetings Netanyahu's having, one with the President of the United States, currently Joe Biden, and one with the presumptive nominee, Kamala Harris, who in March was the first one to really come out and call for this ceasefire. Then reporting since then has been that she has told the president he should take a little bit more of a heavy hand when it comes to Bibi.
His hands are a little bit tied because Kamala Harris is viewed as the continuation candidate. So if he goes really rogue or really materially shifts policy, that could end up weighing on her campaign as well.
That's the latest on the politics. I mentioned the earnings. Alphabet, Tesla, shares are falling in the pre-market after their results failed to impress investors. Numbers from Tesla weren't great, down by more than 8% in early trading. We had Ben Kallo of Baird on the programme a little bit earlier. He's got faith in the story going forward. New product line, robo-taxi, new automobiles. He says you should buy this dip. Alphabet's a confusing one. If you go through the numbers from Google, they really weren't that bad, with the exception of maybe weak performance from YouTube. And getting punished for higher capex spending was interesting too. Mandeep Singh of Bloomberg Intelligence was with us earlier this morning, and he made the point that if Meta comes out with a similar story, they'll get punished next week as well.
This is buy the rumor, sell the news. Essentially, this is a stock that's up 30% year to date. People saw the earnings. They were not bad. They were good, but they weren't out of this world. They didn't promise some sort of new increased revenue in some sort of dramatic way. And putting that together with what Kate Moore was talking about, the gains are so good that some people are just taking chips off the table or whatever cliche you want to say in order to just pause. It goes back to this pausing, this feeling that maybe we need to reassess at a time of transition.
How many things go on pause over the next few months? My favourite line from Mandeep a little bit earlier on, that if the CrowdStrike issues hadn't happened, cybersecurity firm Wiz would have made that deal with Alphabet, and that it fell apart because they think they can do better on their own based on that there's a big opening now.
And he said they probably could if they go public in the next 3 months. So let's see if they go public in the next 3 months.
We need to talk about that tech outage on Friday, and one company in particular that's still struggling with it. The US Department of Transportation opening an investigation into Delta as flight cancellations continue after Friday's global technology disruption. Transportation Secretary Pete Buttigieg saying 3,000 passengers have filed complaints with the department. Lisa did like 1,000 of them. Stephen Trent of Citi joins us now for more. You're surprised there weren't more than that. I think other people are too. Stephen, let's get into this. Typically, when you see outages like this, there is this favourite word of economists that we often hear by analysts as well, transitory. It sort of comes and goes, we move on, it doesn't leave a scar on the stock. Stephen, do you think this moment is different for this airline, which, excuse the pun, has been flying high for quite a while now in this country?
Oh, thank you very much for having me, and good morning. So when we see outages like this, this is a little worse than what would typically see from a network outage or from some kind of weather event. So people think, for example, back to Southwest in December 2022, you saw that carrier's cancellations around the low 70s for a day or two, which is considerably higher than what we're seeing for Delta today. So Delta, we saw a couple of days where the cancellation rates were in the 30s, but indeed it's a couple of days. So Delta did have a technology outage in 2016, and that resulted in, for example, 2,300 canceled flights. At this point, unfortunately, the carrier is above 5,500 cancellations since Friday. So in terms of scale, it is a little bit tougher than most of what we've seen in the past.
Stephen, you know these companies inside out. What is it about how Delta operates that has meant they found it much more difficult to respond and actually make sure they can come out the other side of this faster than the other airlines have? It feels like it's back to business at American, at United. Why can't the same be said about Delta when they all experienced a similar shock?
Yeah, absolutely. So not every airline has the same technological setup. It's conceivable, for example, that the other carriers do not have as much exposure to CrowdStrike, and maybe some of the carriers don't have any exposure. You know, over the last couple of weeks, for example, to its credit, we saw very little disruption with Southwest or Alaska Airlines, for instance, where Delta, for instance, has something like over 10,000 individual systems that it has to restart as a result of this CrowdStrike outage. So the relative exposures are not the same.
I guess there's a larger question here, Stephen, and we've been asking it in terms of how do you diversify away from being so dependent on one system that you could be vulnerable to this type of thing happening? Has anyone been examining the vulnerabilities, not just in Delta, but other airlines as well, in terms of, United was really sunk when there were problems with specific Boeing planes. There is this question now with Delta and CrowdStrike. Are there sort of key vulnerabilities that people are studying within the airlines that could sink entire systems all of a sudden in a flash?
Yeah, it's a hard one because I think the group thinks about these kind of risks all the time. So, for example, today, exactly as you said, if you're an airline that's operating only Boeing 737 MAXs, you have a different set of supply risk, for example, versus a competitor that has Boeing, Airbus, and Embraer planes, for instance. So that's always a risk. In terms of whether these airlines need to have different systems set up, that's something that I think the group is probably going to be looking into. At least elements of the market are going to look into that. On the other hand, there are other risks with having too many suppliers. Just look at global supply chain today. You basically need everything to go right. And I know it's not exactly the same situation, but you need everything to go right. And 2 or 3 suppliers can really, screw up the works, so to speak. So I think in this case, certainly, I would imagine that elements of the group are going to be looking at how to have some fail-safes in their technological supply going forward.
I was struck by the Delta union saying pilots felt, quote, abandoned basically by the system and the company. How does Delta then close basically the trust gap they're going to have with their flyers, but also their staff?
Yeah, so I think you have a situation like this with thousands of flights canceled. Very easy to say that for anybody involved, it's a very emotional situation. And I don't want to dismiss what frustration you may have from pilots or customers or flight attendants. Certainly, they have very real frustrations, and many of them have had really bad weeks. I get that. I think when the dust settles on the root causes of this and how it might be mitigated going forward, I wouldn't say it's fair to take, the worst point of consumer and employee anger and project that forward. This problem did not start with Delta. Delta is not the origin of this technological problem. They are collateral damage, as were hospitals and 911 call centers in various places. So I think the actions that the carrier takes going forward present an opportunity in terms of its relationship with those constituents.
Stephen, great to get your thoughts, sir. Appreciate it. Stephen Trent there of Citi on Delta Airlines with a buy rating on the stock. And I can tell you, the analyst community, incredibly bullish on Delta. 21 buys, 1 hold, and not a single sell on that company, even with all these pictures of people stuck in airports.
Ultimately, and I'm not speaking personally, but theoretically, if someone were to get caught in an airport with a particular airline, you might have some sort of, PTSD, but you actually go fly another airline if you have certain loyalty and you have certain, perks, et cetera, et cetera.
Sure, yeah.
It becomes challenging, and that is what they're facing with.
Do you want to talk about something?
No.
Stuck in Atlanta and still flying with them?
It was horrible.
I feel like I'm the only one that flew Delta over the weekend. It only had a 2-3 hour delay, and it was fine.
I told you on Monday morning, you were one of the lucky ones, without a doubt about it. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. Shares of Visa are down in the pre-market 3.4%. It reported its first miss on quarterly revenue since 2019. It had $8.9 billion in revenue for the fiscal third quarter. That is just barely shy of the average estimate. But credit card spending worldwide has been holding up. It climbed 4.9% from a year earlier. In the U.S., where Visa gets about 40% of its revenue, spending advanced 5.1%. But Morgan Stanley analysts said that investors were instead focused on the slowing travel spend in July. And some good news for the beleaguered plane maker Boeing. The company resumed deliveries of its 737 MAX aircraft to airlines in China. The announcement comes after a roughly 2-month pause imposed by aviation regulators in China to review information about batteries used in cockpit voice recorders in Boeing's planes. Boeing, though, is still grappling with leadership upheaval after being forced by U.S. transport regulators to slow production over concerns around its manufacturing safety standards tied to the Alaska Air 737 MAX door blowout. And the Blackstone Mortgage Trust is cutting its dividend by 24% as defaults pick up and borrowers struggle to make payments or refinance their loans. The $3.4 billion REIT provides loans to commercial real estate groups, and most of the troubled loans are on U.S. office buildings, which make up about a quarter of its loans outstanding. It also authorized a share buyback of up to $150 million, yet the stock is still down nearly 7% in the pre-market trade. In a statement, the REIT CEO said that they were still well positioned with, quote, strong liquidity, accelerating repayments, and an emerging investment pipeline. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, cracks in the consumer.
Consumer spending has been much weaker. It's grown in the first half of this year, but at a much slower pace than it grew in the second half of last year. And that's a really material change in the environment.
We'll talk about those cracks up next on the show. You're watching Bloomberg Surveillance. The opening bow, 1 hour and about 42 minutes away. Going into that opening bow this Wednesday morning, and good morning to you all. We're down about 0.75% on the S&P. Bit of a rally in the bond market. Yields are lower by 2 basis points. The 10-year 422. Let's call it 423. Under surveillance this morning, cracks in the consumer.
I can understand why the Fed has been so cautious after the whole transitory fiasco, but I think I'm getting close to the point where I think they're too late now. The lagged effect of the Fed's actions are beginning to kick in. Consumer spending has been much weaker. It's grown in the first half of this year, but at a much slower pace than it grew in the second half of last year. And that's a really material change in the environment.
So here's the latest. Investors looking for insight into the state of the economy with GDP and initial jobless claims due tomorrow morning. The former New York president of the Federal Reserve, Bill Dudley, writing this. The facts have changed So I've changed my mind. The Fed should cut, preferably at the next week policy meeting, although it might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk. Winnie Cisar of CreditSights joins us now for more. Winnie, this line from Ian Shepherdson, I think it's getting to the point where they're too late right now. Winnie, what do you make of that and what we've heard from Bill Dudley already this morning?
Well, I think that the change in tone that we are seeing kind of across the market is quite notable. We went from pricing in 200 basis points of rate cuts at the end of last year to no rate cuts earlier this year as economic data came in stronger than anticipated. And now we're seeing a shift again. So I think that the big takeaway is people are having a really hard time tracking where exactly this economy is going to go. Now, we do agree with Bill Dudley that we should probably start to see rate cuts sooner rather than later. We have a September rate cut penciled in and rate cuts continuing thereafter at every meeting at a 25 basis point clip. And that's very much predicated on the consumer slowing that has already started to materialize and probably will continue at least through the second half of this year.
Lisa told me a long time ago that when the economy gets bad, credit spreads get wide. I don't believe her anymore, Winnie, because I don't see it. 300 basis points, high yield spread, super tight. We're less than 300 now. Does credit give you that cyclical signal that it used to give you all those years again, or has something changed?
Well, the big change that we're seeing right now is that the yield environment is still very different for a lot of investors in the post-GFC era. We still have high yields closing in on 8%, investment grade north of 5%. And as we balance the spread proposition to the yield proposition, people kind of look at credit yields and think, oh, this is okay. But the reality is spreads are very tight. And with July being a seasonally very strong month historically, we have been recommending that clients start to go a bit up in quality, sell into some of this strength, and really put cash to work in the things that have gotten cheaper, relatively speaking, in the higher rated parts of the market.
That said, Winnie, there usually is a correlation between small caps and credit spreads. And what you're seeing right now is actually a rally in small caps at the same time that we're seeing a shift in tone. I mean, it all is a bit circular and head spinning. Is this really just a valuation play at a time when people see the softening is not necessarily being a wholesale recession?
Yeah, it's really interesting because within the world of corporate credit, there have been a handful of sectors and issuers that investors have basically said, nope, we're not willing to extend these capital structures. We think that they're over leveraged. We think that there's some sort of secular decline within the business or within the sector more broadly. Whereas we're seeing that, rotation into small cap equities. And so it is a little bit of a head scratcher, those two different dynamics. And, generally, I do think that credit markets tend to get things pretty right. They are kind of the driver of where liquidity goes within the system. So I'm really paying close attention to the reality that CCC spreads are still wider on the year, despite this recent rally in small cap equities.
There's also this larger question of how quickly things are deteriorating. There was this feeling from Bill Dudley's column that it's actually faster than he thought it would be. We heard the same kind of tone from Ian Shepherdson. It is too late at this point, potentially, to get ahead of a recession. Is there anything in the granular data from companies, from different earnings calls that you're hearing that suggests that things are truly rapidly deteriorating in real time?
So this is a really interesting question, and I rely very much on my analyst team at CreditSights to help me navigate some of these nuances. And I would say my consumer team in particular has been highlighting probably for the past 3 to 6 months that consumer behavior is shifting quite notably. They see that in management commentary, they see that in earnings results, reflecting a downtrade in terms of store brands versus regular brands, a deceleration in restaurant traffic and restaurant spending, different types of spending versus services versus goods. And so we are very focused on some of those more granular data pieces that our consumer team has been seeing and highlighting for the past 3 to 6 months or so.
Winnie, awesome to get your perspective and your view over at CreditSights. Winnie Cisar there of CreditSights, looking for that consumer-led slowdown. Citi also looking for the same thing. They're looking at housing. Citi and Andrew Honhorst saying the housing sector is often a leading indicator of broader economic strength and suggests softer growth is coming in the coming quarters. The housing data not tremendous in the last 24 hours.
Yeah, we got some negative data yesterday, not only the Redfin data that you were talking about, but just in terms of some of the home sales coming in much lower than expecting. Existing home sales coming in, falling to 3.89 million versus 3.98 million expected, falling to some of the lowest levels in many months. This is the question. Are we seeing a real-time deterioration that doesn't happen in a linear way? And that is really the concern. I mean, the Redfin data, I want to sit on that for a hot second because it indicates that people are taking a look at their expenses after making a deal and saying, this is not going to work, and they're doing it en masse. There is something significant in that.
I'm really looking forward to Chairman Powell this time next week and his characterization of the labour market. It was only a number of weeks ago that Chairman Powell was addressing the country, financial markets, economists, and basically saying the economy is okay, the labour market is still strong, and because of the labour market strength, we have time. And now you're getting warning after warning about just how much time we have and just how strong this economy and this labour market actually is.
Two things. He can either signal that definitely they're going to go in September and set that up. If he goes this week, or next week rather, there will be concerns about what the political sort of understanding of that could be, especially because of some of the recent political turmoil.
This is the difference between being a sitting Fed official and a former one.
Correct.
If a sitting Fed official used some of the language that Bill Dudley's used in this Bloomberg opinion column this morning, I think it would spook this market big time. Like, get a move on, you might already be too late. Like, that is some spooky stuff if that came from the Federal Reserve directly. The third hour of Bloomberg Surveillance, up next.
The process of diversification is necessary, but you need exposure to these magnificent seven.
We want to be a little bit more defensive. It doesn't mean equities can't do well. It's the larger cap. It's the higher quality. It's because growth's slowing.
In the small business sector in particular, the squeeze is quite intense.
In pockets of small caps, there's still a lot of opportunity.
Inflation's moderating, so it's an ideal scenario for the stock market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. 90 minutes away from the opening bell with tons of stuff to get through. Lots of news flow. Let's start with equity futures on the S&P 500, pulling back on the S&P by something like 0.75%. A much bigger move on the Nasdaq 100, down by 1 full percentage point, with Tesla dropping in the pre-market by a little more than 8%. Another disappointment for the EV maker led by Elon Musk.
This is a fourth straight miss versus expectations for Tesla at a time when this is becoming an increasing hope trade more than reality in terms of justifying valuations. I say hope with respect to the robotaxi and getting that up to speed. A real question here is how much longer can he hinge on that hope versus just actually delivering over the longer term?
This gets big tech of the earnings season for mega cap tech really going. Over the next week, it picks up even more. You'll hear from the big players, the likes of Apple, Amazon, Microsoft, Meta, all next week. But there is some momentum building here. A lot of people starting to come on the program and talk about the need to cut interest rates and cut interest rates like right now. We heard that from Neil Dutter of Renmac. Others have followed. Earlier on this morning in Bloomberg Opinion, Bill Dudley, the former New York Fed president, making the same point. I've changed my mind. The Fed needs to cut rates at this meeting in July. Look, I think most people on Wall Street don't expect that to happen. Will it be a live meeting? I've got no idea. Based on the communication from Fed officials over the last few weeks, they've been pretty consistent. We're getting closer. We're not there yet. What's behind some of these worries is important. So let's tease it out. It's concerns around the labour market, and that makes jobless claims on Thursday even more important.
Especially because we have seen an increase that has been fairly steady, albeit from a very low rate. Here's the issue. Are things truly deteriorating that quickly, or are people just reassessing the data that already is out there? The earnings are not providing a clear picture on that. The rhetoric isn't necessarily clear. And the market's action also very confusing. There is no reason, if people are truly worried about a truly weakening consumer, that you see small caps outperforming and credit doing wonderfully. So it's a real sort of contradiction.
This is why the labor market's going to be in focus. Jay Powell said to the Senate Banking Committee, the labor market appears to be fully back in balance. At the same time, what we hear and what Dudley's talking about is the fact that there's this bifurcation. And what we're seeing, even LVMH, is the higher end potentially is not spending as much. It was the lower end for a while. Walmart trading down. Winnie just talked about that. She's seeing more consumers trading down. Is that going to happen now across the socioeconomic spectrum?
That deceleration in LVMH revenue growth is notable, that's for sure. We're looking at 1% for the fashion and leather goods revenue in that division, 1% growth. Go back 12 months, you're looking at double-digit growth. And now we're talking about double-digit declines in the region that includes China. That name is down by about 4.5%. It's been a terrible time for luxury players over in Europe over the last few weeks. We've talked for a long time about easy financial conditions, tight credit spreads, equities still near all-time highs. That's still the story. Credit spreads are incredibly tight. The equity market's not a million miles away from a record high. But Andrew Hollenhorst of Citi published this just moments ago. And Andrew Hollenhorst of Citi has been making this argument for a while. You're going to get the slowdown in the economy, and when the Fed starts to cut interest rates, they'll cut rates more than you think they will. This is what he has to say. The commencement of Fed rate cuts was supposed to be a risk-on moment for markets. Instead, it's got a different view. Equities are selling off just as the Fed prepares to lower interest rates. The sell-off, if continued, Lisa, could provide another impetus for more dovish Fed policy. It's quite a big call.
It's also quite a few steps from where we are. It's not as though the market is falling out of bed yet. And the areas that are falling are the areas that did the best so far this year. That said, it sort of shows the asymmetry in the market response function that the Fed has. Markets go to record highs. That's not a reason not to potentially cut rates. But if they start falling, that is a reason to cut rates. Do they really go back to that kind of asymmetric relationship?
There's some real asymmetry there. Let's get into the equity market. Let's start here. Counting it down to the opening bell, equity futures right now down by about 0.75% on the S&P. In the bond market, yields are lower by a couple of basis points. The 10-year 422.91. In foreign exchange, the euro, a little bit of a snooze. I think dollar yen wakes you up just a little bit more, Lisa. 3 days of yen strength. Haven't seen that since early May.
Coming off some of the weakest levels that we've seen in many decades, a question of how much this is a Japan issue heading into the Bank of Japan next week versus a U.S. dollar issue as people look to an almost sure thing of a Fed rate cut in September.
That's some divergence, isn't it? If we get a hike from them and a cut on the other side, we'll see. Here's the lineup this hour. Sebastien Page at T. Rowe Price as the start of Mag 7 earnings fails to impress. Bloomberg's David Welch has tested reports a fourth straight quarter of profit losses. And Michael Kushma of Morgan Stanley on why soft landing prospects remain on shaky ground. We begin with the big issue, disappointing tech earnings weighing on stocks this morning. The results coming just as investors start to rotate out of tech and into small caps. Sebastien Page at T. Rowe Price expecting markets to broaden out, saying this: we're not in an internet bubble, but in 2001, when the tech trade unwound, value outperformed growth by 45% in 12 months. Stickier than expected rates and inflation could favour value. Seb joins us now for more. Seb, it's good to see you. Good morning.
Great to see you.
Kate Moore of BlackRock on the show earlier on. She said she had doubts about how durable this rotation might be. You don't seem to have those doubts. Share them with us.
More confident on the value side of the rotation than on the SMID side. And within small, we like mid better than small caps. So look, it's not a pound the table call. We are overweight value. You saw my quote about the tech bubble. This is not the tech bubble. And here's an interesting thing you can do. Adjust price earnings ratios historically for return on equity. And what you'll find is that we're in an environment where those mega cap techs have unbelievable return on equity, unbelievable fundamentals relative to the tech bubble. But nonetheless, trees don't grow to the sky. These things can revert really quickly. Even in 22, you had value outperform by 20%. So if you take a 12-month horizon, you look at the election and some of the possible catalysts, we're long value.
Mandeep Singh of Bloomberg Intelligence was making the point that some of these mega cap tech names might actually get punished for increased capex, even if it is around AI, even if there is this huge amount of enthusiasm for that particular theme. What do you make of that call? Could we see these companies be punished for the investment decisions they're making if the revenue story doesn't follow quickly?
Look, these companies are doing really, really, really well. The problem is the way markets work, the expectations are just really high. I've said this before on your show, Jonathan, the secret to happiness in life is low expectations. That's a problem for mega cap technology companies. So yes, they could disappoint because the expectations are just huge. There are 4 stocks right now in this earnings season that are expected to grow earnings by 56%. And I think the market is extrapolating this kind of earnings growth a little too much. If you look at projections towards the end of the year, value stocks year-over-year earnings growth is expected to outpace year-over-year earnings growth for growth stocks. Just wrap your head around that. I don't think the market is pricing that right now.
So the rotation is selective within the big index, not necessarily beyond that. As you look to stocks that haven't necessarily been bid up as much as others, how much are you still aggressively neutral?
Yeah, we actually have a 0.5% overweight stocks, but it's not worth talking about. We are confidently neutral, and this means
is that a downgrade?
Aggressively, confidently, with lots of conviction, neutral. And the reason why I emphasize that is you have a risk tolerance that you work on, say as an individual investor with an advisor. There's a lot of work that goes into that. That's what I'm arguing for. I'm not arguing for being in or out of the markets. As an investor, what is your long-term risk tolerance? And this is kind of where you want to be right now. The bears on our asset allocation committee are talking about decelerating economy into very high valuations. That's compelling.
Sure.
But we have raging debates because what are the bulls saying? They're saying earnings are coming up and rates are coming down. So these are tough debates to have as investors. Figure out your risk tolerance. It doesn't have to be 60-40. If you're far away from retirement, it should be more stocks, but stick to that.
Is it basically 60-40, the bears and the bulls on your investment committee, where basically the 60% sit on one side, the 40% sit on the other? Has there been a shift where more people are starting to see the deceleration and getting more cautious, or is it still aggressively balanced in those debates?
Look, it's fairly balanced, and to let you in something that happens in asset allocation committees a lot, the bond managers tend to be more cautious.
Oh, you don't say.
The stock managers tend to be more optimistic. But when you have these discussions, you kind of know where people stand with their biases, and then you adjust for it. But this is a market environment. I got to say, we've never had this intensity of debates between bulls and bears.
You've got a paper coming out later this year on leadership. You can share some of the details of that with us now if you want to. Just give us some insight into how you help the committee come to an agreement when there is that kind of division between the bulls and bears around a table?
Well, here's the key thing about the committee, which has been over several years a huge improvement to our decision-making process. And the research shows this helps, bring an independent view to the table. So we have a pre-meeting survey where every member will disclose what they want to do in terms of tactical asset allocation shift, not knowing what the other members are suggesting. So we have independent expertise brought to the table, and then we debate it. That's an improvement to decision-making processes. On the psychology of our business, I've become quite passionate about this. John, there's a huge link to sports psychology because sometimes you win, sometimes you lose. You control your process, but you don't always control the outcome. Doesn't that sound like sports?
Sure.
And how do you build resilience to setbacks in markets? So there's a huge unexplored, I think, research body or body of research that can apply to money management that we haven't. So I'm putting out this article, Journal of Portfolio Management, later this year.
The psychology of paralysis right now is something that I'd love you to comment on. There have been a number of people, guests on the show this morning and in the past week, who seem rather mired in this period of uncertainty ahead of an election, potential policy shifts, and frankly, such big dissonance between the bulls and the bears. How do you get away from that paralysis?
So, staying on the side of psychology, there's something called core beliefs, which is how people look at the world, their biases to interpret events and make decisions. Well, investors have core beliefs. And if your core belief is that you should stay invested for the long run, then maybe call it paralysis, but maybe call it just good investment discipline. So I don't equate paralysis. I think you need to stay invested, stay diversified. This is very trite. But you step back and you ask, what are your investment core beliefs? Are you a follow-the-trend investor, or are you a valuation-focused investor?
Well, let me pick out one, and I think this might be an interesting thing to explore. We're getting deep in the weeds here and away from the news flow, but we've got a few more minutes. I think if you are raised and you have a career exclusively in the United States of America, your core belief is to stay invested. I think if you have experience outside of America, you have experience knowing that that doesn't always work, and there are such things as lost decades. And I think a question I would have for you as an asset allocator who has a core belief, I know, to stay invested, when people offer that example to you of what has happened elsewhere, in stock markets in Europe, Japan, and elsewhere too, what do you say back to that? Do you just maintain this core belief that America's different and it will always be the case that you just stay invested and you'll be rewarded for it?
John, I do, because this is the engine of growth for the world economy. Innovation, the way we run our country, generally, I tend to be an optimist. The entire post-World War II experience shows us that it pays off over the long run to be invested in stocks, and that is different from different experiences. Now, it's probably a longer topic, but I am worried about the level of government debt, and this is kind of a longer-term problem that we need to think about.
Lisa agrees. Seb, it's good to see you. We'll have a longer conversation next time. Sebastien Page at T. Rowe Price. I think we all agree on that point. What would undermine that US exceptionalism? What would change that story? It's a big question you've got to ask.
Potentially, that's the reason why the government debt becomes an issue. There's also this issue of just politically, are certain countries trying to diversify away from dollar assets in some of their holdings? There's longer term sort of questions of the dollar's preeminence, but ultimately it does come down to the currency and to the debt markets.
That got a lot deeper than I thought. Seb, when you publish, come back and we'll talk about that paper, OK? Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. CrowdStrike, the cybersecurity company at the center of last week's massive IT outage, is blaming the issues on a defect in a content update. The company said a bug in the safety mechanism allowed flawed data to go out to customers. It added that a new check is in process in order to fix the faulty content validator that failed, and there are plans in place to stagger future deployments of updates before rolling them out at large. CrowdStrike CEO George Kurtz has been called upon to testify before Congress over the meltdown. And there is some rare good news for the beleaguered plane maker Boeing. The company resumed deliveries of its 737 MAX aircraft to airlines in China. The announcement comes after a roughly 2-month pause imposed by aviation regulators in China to review information about batteries used in cockpit voice recorders in Boeing's planes. Boeing is still grappling with leadership upheaval after being forced by U.S. transport regulators to slow production over concerns around its manufacturing safety standards tied to the Alaska Air 737 MAX door blowout. Elon Musk has confirmed that he has donated to a super PAC supporting Donald Trump's presidential campaign, but he's not pledging to give the $45 million a month that was previously reported. In a post on X, Musk acknowledged that he had donated to the America PAC, which focuses on get out the vote efforts, but he didn't say how much he contributed. America PAC raised $8.8 million in the second quarter, spent $7.8 million, and started July with a little less than $1 million of cash on hand. That's according to a recent filing with the Federal Election Commission. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, we'll get you some morning calls, plus Bloomberg's David Welch on Tesla's disappointing results and the delay of the robotaxi. That's up next from New York. Good morning. Let's start with stocks, then we'll turn to bonds. Equities on the S&P 500 down by close to 1%. There's a couple of reasons, literally two. We can talk about them throughout this morning going into the opening bell. One is Alphabet, the other's Tesla. I'll get to Tesla in a moment. I want to talk about the bond market. Yields lower by 2 basis points, 422.52. Lots of conversations about the shape of the yield curve, including one around this table. Lisa, what have you got?
Well, basically, the curve steepening does continue. Basically, have the narrowest or the smallest negative curve inversion for the 2s, 10s. Basically, 2-year yields are the least amount higher versus the 10-year yields going back to the beginning of this year. What this is basically a bullish steepening. This is a bull steepener. People expect the Fed to be cutting rates at a time where they can still avoid some sort of recession. So you're not necessarily seeing longer-term yields fall out of bed. At the same time, they're not either rising dramatically. So it's not necessarily punitive. It's sort of what people have been wanting to see at a time when the Fed is expected to cut
This
rates.
is what we expected at the start of the year. Then things changed. We had that inflation head fake of Q1, if you can call it a head fake, but certainly that changed the story. That's the bond market. Equity's a little softer. Let's get to the why. Let's get you some morning calls. One stock in focus, Tesla. First up, Citi, lowering its price target on the EV maker to 258, keeping a neutral rating on the name. The analyst saying the stock set up into October only improves if consensus is lowered and shares pull back. We're pulling back right now by more than 8%. Your second call from Cantor Fitzgerald, downgrading Tesla to neutral but lifting its price target to 245. The analyst saying valuation is the reason behind the downgrade following lackluster earnings results. And finally, Wedbush maintaining an outperform rating and $300 price target on the name. Dan Ives is sticking with it. Ives is saying he wasn't looking for major fireworks this quarter and now expects the delayed robotaxi unveiling to unleash the beginning of a $1 trillion AI story. OK, I've got another call for you, so let's squeeze the fourth one in. Pierre Ferragut of New Street Research. This is a rare downgrade for him on the name. Downgrade to neutral, 225. The headline, margins will take time to recover. There's a lack of near-term catalysts. We tactically downgrade the stock to neutral. I'm going to read some of this with you. It's just dropped in front of me, so bear with me. The stock is at our target price, trading on 50 times our 26 estimate. We see limited and unreliable valuation upside and limited risks of material positive revisions on that time horizon. The next inflection in the stock is unlikely in the next 12 months, 225. Target price. David Welch of Bloomberg joins us now for more. David, that's the south side. Let's deal with the numbers, what you and the team were looking at yesterday afternoon and what you heard on the call as well. What jumped out for you, David?
Well, look, the numbers for the EV business we knew weren't going to be great, but they do just continue to deteriorate. And you know, a big number to look at is automotive gross margins, and part of this is they're not getting pricing. So down from 16.4 in the first quarter to 14.6. This is something that's just been declining for them for a while. So it's just a lot tougher for them to make a lot of money in the EV space. They do have the Cybertruck out there, but it's not selling in huge numbers. It is selling in good numbers for an electric pickup truck, but it's not the growth engine that Tesla really needs to get interest in the stock again. So we've got this AI story. Look, the revenue is strong, but a lot of that's the energy storage business and also regulatory credits. I think the credit side they can sustain for a while, but that's not why people buy the stock. So now we're sort of back to where Tesla was kind of over a lot of its history, where the fundamentals aren't great. So Elon Musk is bringing up this story that that the cavalry is just over the hill with a new growth engine, this time being AI and self-drive. That's really, I think, a tough one for investors to get their arms around. The reason there's still hope for it with Tesla is because a lot of people have lost a lot of money betting against Elon Musk. But if you look at autonomy, take Alphabet Inc. With Waymo, they've been testing these vehicles for 13 years, and still they only have kind of modest number of vehicles out there in certain markets, bringing in a little bit of revenue. It's really still in the test phase. So how does Tesla get out of that quickly to show big growth and that they're a leader in autonomy, which is a really difficult space and a very difficult technology to master? So you've got believers and doubters on that front, and Tesla, I think, is once again a battleground stock based on what you think about autonomy and their prospects there.
And David, based on the fact that people do believe in genius founders, and that has been one of the big arguments to go with Tesla. That's why it's not valued as a car company. It is valued as a company that innovates. This Pierre Ferragut call that John was reading out and talking about also includes this line: the FSD, full service driving, robotaxi, and Optimus remain longer term moonshots. David, do you get the sense that people are losing faith that Elon Musk can monetize some of his innovations and, frankly, truly genius types of ideas into something concrete?
Yeah, I do. And it's not necessarily that they're doubting that Elon can make AI and autonomy work. There's just a lot of doubt that anyone can. You've got some really good minds out there who've been working on this for years now. And also with AI, particularly in the auto space, with autonomy, it's always failed it's never failed to disappoint is the problem. We had a lot of startups that got funded and they all died. Cruise and Waymo I think a lot of people thought they'd be doing more than they are right now, and they've been at this for a long time, and they haven't. And Elon Musk promised that there'd be a lot with autonomy years ago from this company, and now it's the new thing that he's got. But we don't see his cars being tested on the road in the way that we did with Cruise and Waymo and others. And you don't see a lot of miles being driven. You don't see a lot of reports with California, for example. So there's just nothing tangible for investors to grab onto and say, yes, the testing is going well, so we're going to see a real business here that rolls out and starts to bring in a lot of money. So the doubt may not be specific to Elon Musk and Tesla in this case. It's just that autonomy really is a difficult, technologically speaking, thing to crack, and also tough business case because no one's really kind of figured out how much robotaxis can charge, what the margins are really like. So many question marks here going forward. It's hard for an investor to say, yeah, I'm going to bet on this in the next couple of quarters.
Yeah.
And by the way, we're only going to see prototypes in October. It's not like you're going to see businesses rolling out and bringing in revenue a month later in November. It could be well beyond that if we're only going to see prototypes in November. So look, a lot of to be seen here in the future from Tesla.
Elon Musk was pretty blunt about it. If you believe in it, stay in the stock, and if you don't, you should sell. David Welch at Bloomberg, which is pretty refreshing to hear from a CEO on a call. He's done that kind of thing before.
Ultimately,